Welcome. This is our third quarter edition of 4 for the Quarter. I'm Lauren Sanfilippo, Senior Investment Strategist with the Chief Investment Office, and I'm joined by Chris Hyzy, our Chief Investment Officer for Merrill and Bank of America Private Bank. Thanks for being with us today, Chris.
Great to be back.
I want to start off with there's a lot that's gone on in the first 7 months of this year.
Right.
A lot of skepticism around the AI trade, right? A lot of market action that's come from that. A lot of questions around various policies, whether it's Fed policy, tariff policy, a lot of uncertainty geopolitically, so maybe foreign policy, throw that in there. I just want to start off with your high-level thoughts, Chris.
Sure.
What do you think investors are really looking at?
Well, I think you nailed it in terms of there is a big list. We always talk about climbing the wall of worry. I would argue it's a lot bigger wall now. We still have geopolitical risk, but the new one that's coming up is the backup in long-term yields. Right now, as we sit here, give or take, we're at the highest that the 30-year bond yield has been in the U.S. since 2007. And everybody goes, 2007, wow, 19 years ago. And I look at it a little differently because you're also looking at the artificial intelligence space and the build-out space of that particular area. And some of the large hyperscalers, the insurance against defaults on their bonds is also rising. And you've got higher debt financing. When you see higher yields, higher debt financing, the real question then becomes, is this the top? Not necessarily in the market, but is it the top in the enthusiasm of this great new innovation? So we're watching this very closely, and we don't think it is. It's far too early to suggest that. CapEx is still going up. Is it going to go up and grow as much in the space as has already been announced? Not likely so. You can't grow 40%, 40%, 40%. Until you're in the sky. So eventually you're going to see a cresting in that and then allow that CapEx build to filter into other parts of the market and then ultimately efficiencies and productivity come after that. But right now, investors are impatient. We see it in the market. There's a lot of rotation and rebalancing going on and not a lot of talk about it.
Yeah, I actually want to start with artificial intelligence this time around. So for our first question, I want to ask you, of course, there are a lot of different market shifts when it comes to the narratives that are happening around AI, whether it's growing skepticism over some of that return on investment, like you said, or even competition from China. And so as you said, this is going to be a long investment cycle. Last time we spoke, you said we were in the second or third inning of AI. Is that where you still see this innovation cycle?
Yeah, and if you had to go outside the sports analogy and you had to think about waves in terms of phases. We all know the life cycle curve. The difficulty with the life cycle curve is how long is the actual life cycle itself? And that's what's tough to figure out. But we think we're in the third phase of 6. What's the third phase? It's where the second level of competition comes in. There's a number of providers out there that they see the large profit margins. They see the undersupply of the key components to drive the innovation. They see the fact that $1 of capital is coming in and everybody wants to share in that. So you ultimately see high competition come in that ultimately takes the high cost of tokenization and other things, and it starts to push it down a little bit. So initial fear is, wow, this costs a lot. And then competition comes in, and then the fear is like, wow, they can do it better and cheaper. The reality is that's good. Competition breeds competition. So we're in that third phase. The fourth phase is where the new innovation comes on top of the previous one. And that's like quantum computing, physical AI, and all of that also needs advancement. So we're in that not yet middle innings, but early innings, and it's causing a lot of worries as to how far in the cycle we are. And we still think we're not yet at the middle stage.
Right. Okay, so then for our second question, I guess I want to shift to corporate earnings.
Yeah.
And what we've seen in the first quarter, and now second quarter earnings being announced now, very impressive results, right? We're talking about growth rates that are certainly not typical.
Right.
So I certainly want to ask you on this point, how sustainable are these corporate earnings? The reports, the aggregate numbers, I mean, you think about 2027, It seems like we're setting up for tough comps.
Well, it's a great question and how you put it, because how sustainable? It's hard. It's hard to sustain 20%, 20%, 20%. But when we talk about attractive earnings growth, it is our belief that it is sustainable. We're working off of a world nominal economic growth rate somewhere above 6%. In the US, around 6%. That's very rare. And you could argue, is it half inflation and half real? Or you could just accept the fact that that's where we're at. that leads to better revenue growth. And when you have an innovation like this that you can use on your cost line, you get wider operating leverage, wider profit margins that can hopefully sustain what looks like abnormal earnings growth. Will it be in the 20%? Not likely. So now, between now and the end of the year, we're going to hear questions like, the second derivative is slowing down. So we went from 20% earnings growth to 13 or 14, and the market's not going to like that, right, Chris and Lauren? And the reality is, no, not initially. But then the market gets comfortable with that and says, wow, that's still a very good and attractive earnings growth rate. So heading into 27, we'll hear stories about that. Full year 27, a little early right now, but when we look at corporate guidance, the latest corporate guidance, it appears that we're still going to be like in that low double-digit earnings growth period, which is what everyone thought this year was going to be.
And on top of all of this, while there's been impressive corporate earnings, of course, we've seen leadership at the Fed change, right? So Kevin Warsh is now installed. Yep. I want to talk a little bit about what that means for investors. The market's looking for rate hikes by the year end. So what's your view on this?
Well, we also know this. The market doesn't like a slowdown in the second derivative. It also doesn't like change. And we have not just a change at the leadership, but potentially a change as to how the reaction function is reviewed by the current Federal Reserve, particularly this particular chairman. He's asked 5 task forces to come together and to assess various components of what the Fed should be looking at to determine policy. These task forces are just getting going. So it's very difficult in 8-9 weeks for policy to change right out of the gates, like we've already seen in the last 2 meetings by this new Fed leadership. So hikes right now, BofA Global Research has in official forecast 3 hikes, September, October, and then December. And when we step back and we look at that, that's kind of where the market is coalescing. Most recent communication coming out of the Federal Reserve is we're going to let the task forces do their job, assess what type of new information we're going to be looking for. How is that going to determine policy of the future? They're looking at inflation dynamics, a new framework for it, how the yield curve is reacting, and they believe that the bond market should be the determinant of the cost of capital. And that's very different than previous regimes. And the market's trying to figure all this out right now, while potentially getting less guidance, is what they also said. So it's going to get interesting. We've seen that already. But once they get into their swimmer's stroke and the market starts to understand the direction of this current Federal Reserve, we think we go back to what it always has been, which is tell us what the reaction function is and we can understand it.
That's helpful. For the fourth question, I want to talk about sort of a feature of the market that seems to be this year at least, right? We've seen some broadening. We've seen some narrowing again. I want to talk about the rotation that everyone's talking about, right? Is it rotational? You've called it a little bit more of a rebalance. So what's your take on this?
Right. So let's put ourselves in a boat right now. And we're leaning one way. And we're not looking at the waves. And we automatically go to the other side of the boat without assessing where the wave is coming from. What happens if that wave comes underneath and the boat topples over? That is a pure rotation in the market. That's why I like to say this is a rebalancing. You don't automatically go from one side of the boat to the next unless you assess the entire landscape. And that's where we're at. Small caps are quietly outperforming. Mid caps right behind there. There's components of the international markets that are coming back to the leadership rankings. No one is talking about it. There's value is vastly outperforming growth. And yet you see a space like the semiconductors, semiconductor capital equipment, down 30, in some cases a lot more than that, 20 to 30 to 40% from their June peaks, but the market's only down at this point around 3% from its peak. That's very healthy. That means other parts of the market are now first derivative growing higher than what everyone expected, while some parts are growing a little bit slower, even though they're still growing really, really well. That is a pure rebalancing. This takes a few years to go through. We're still in the early stages of that, and we think this is healthy for overall portfolios, healthy for diversification, and in fact, this is a healthy sign that we are not at a top. Now, if CapEx slows, that's one thing. If CapEx slows aggressively, while the cost of capital to fund it goes up, that's not good. We're not seeing that. So it's hard to suggest that this is a top. Is it a short-term top as it relates to what happens in the internal parts of the market for some of those stocks? Yes, because now we have to reignite enthusiasm for buyers to come in. Some of these companies have now corrected to multiples well below the market. So it's a clearing event, it's a de-risking event, And we believe for those underexposed to those areas, it's attractive. For those overexposed to those areas, in the next few weeks to a couple of months, take the advantage to diversify out into some of the other areas that are rebalancing forward.
So we're still in this choppy pattern.
Yes, I think we'll be there for a while.
I want to ask just a couple of honorable mentions, right?
Yes.
More of a lightning round. So I have a couple of topics here that I think investors are wondering.
Sure.
For the first one, U.S. exceptionalism. Is it over? Is it just getting started? What do you think?
I think that's a very, very strong word, and I would say no. I said competition's very good. We've got competition from all over the world, but we are the leaders in the world, not just the size of the economy. We are the leaders of the world in innovation, and it's not just in one space, it's in a variety of areas.
So that diversification to our economy, hugely important.
Yes.
What about, we're 100 days now, less than, we're actually within 100 days to the midterm elections.
Yeah.
Thoughts here, how should investors be thinking about this?
It's in the back of our minds, not in the front of our minds. It'll certainly be in the front of our minds post-Labor Day, and you'll see a lot more volatility within the markets because of it. What we've also seen is once we've reached the low point of concerns around change, ultimately 12 months later, we've seen a significant movement back upward over the course of history. So we're going to use that as our guide.
Awesome. And then that leads me to just our last lightning round question here. What's the biggest risk for the next 5 months?
It's certainly spreads. What's going on in the bond market, not really in investment grade, but below investment grade. Is it just a move out wider, or is it a blowout? We don't see a blowout, but these are flare guns that go up from time to time in some of the lower quality areas. And does that inform what might go on in the higher quality areas? We don't think so, but certainly the credit markets are early, and we should always be watching the credit markets for signs of ultimate stress. Again, early times, we don't think it's going to filter over, but it's always a good area to watch.
Awesome. Thank you, Chris.
Thanks, Lauren.
This has been 4 for the Quarter. We'll be back in the fourth quarter.